Hi everyone, and welcome to another session at the Risk Awareness Week 2020. Please remember to keep this interactive, ask questions underneath this video, and whenever you disagree with something we say or you want to ask a clarifying question, just write it in the comments below. Today I am joined by Lois Tullo, who has over 30 years of business risk technology experience as a board member, CRO, CFO, and at the academic level. I'll let Lois to introduce herself. Lois, over to you and welcome.
Thank you so much, Alex. I'm very pleased to be here. To give you a little bit about myself, I'm not your typical practical Canadian. I have experience working across the globe, Ethiopia, in Europe, down in the US, South America, across many different organizations. CFO at one of the 5 major Canadian banks. Right now, I'm also the CRO for a startup crypto derivatives company. So a very varied background, as well as teaching risk management for the last 24 years.
So that sounds exciting. That's a wonderful setup for our conversation today. So what did you want to talk about during this session, and what do we want to share with our participants?
Well, really looking at how do you link risk to strategy. And I know that that's a conversation that many of you have had before, but it's very difficult to link those risks to strategy. So say your strategy is to grow your market or to expand. How do you actually do that? And we're going to talk about some of the underlying assumptions, starting from, a higher level, but then really driving it down to what does that mean for your business as far as cash flow, as far as your supply chain, really looking at how your employees are affected, how your markets, how the volatility of your prices are affected. And we're going to talk about, some of what's been affected by coronavirus, COVID-19, but then also some of the other issues that are changing the way that we do business, such as cyber, such as extreme weather events.
And that's a wonderful topic to talk about. And because we have a very varied audience from different parts of the world, from different industries, it will be weird for some of us and kind of normal for others, because if I understand you correctly, in financial services, this concept of non-financial risks is the current big thing. Because I'm guessing the banks have figured out how to quantify market and credit and liquidity risks, and they're now starting to think about all those non-financial risks, which is wonderful on one side for the financial services, kind of weird for the non-financial services, because we actually went the other way around. And non-financial companies have learned how to quantify operational risk much earlier than they did learn how to properly quantify the market and credit and liquidity risks. And let's expand on that. What's our main message with non-financial risks?
Yeah. So if you think about first what the definition of non-financial risk and sort of expand out operational risk. So within operational risk, it really started, and I will say that my bias is towards the financial services market, because that's where I've spent, the bulk of my career, really looking at, Barings Bank, but they linked it to market risk, but it really was, the one person that they had relied too much upon. So, linking to fraud and everything that goes with that. Now, if you expand on that to cyber and to anti-money laundering, expanding out to looking at the spread of viral diseases and the effect that that has had on our world trade centers. I'll give you an example. If you were in Toronto, all of the individuals have stopped working in the core of the center. So they've all moved to work at home. And so that's not just affected financial institutions, but it has affected the real estate market, has affected all of the underlying services that support that core. So that when you look at the link between strategy and risk, at the outside, you've got COVID-19, but then you've got to link that to, well, what are the supply chains that organizations are really focusing on? And that supply chain in this case are the real estate, the workers that are coming in. We have seen not just within Canada, but all of North America, Europe, to the rest of the world, our governments have been making huge deficits in order to support economies. The assumption was initially that we would see businesses immediately shut down. But because of those transfer payments, we have pushed out that cliff. And so when you look at the underlying assumptions, you've got to really go down to what does it specifically mean for my business?
And let's expand on that, because this is a very important message to all of our participants. And what I'm hearing is the message: strategic risks are an important consideration, and it looks like different external influences affect our businesses in very significant ways. So it's not an afterthought. We can't just ignore it. We have to be very mindful on how climate change, the push towards digitalization and all the cyber kind of implications of that, the coronavirus, and all of the other big global ideas and themes, how those affect our local business strategies. And the one way of doing it, and I think this will become the theme for our conversation, is that to take any big global risk and to try and comprehend how that global risk can affect the business, and to simulate or stress test how that global big thing can affect our bottom line, our cash flow, our liquidity within the business, we really kind of have to start backwards. We have to look at what are the underlying assumptions that go into the strategic planning or business planning. So, for example, a business that is the business that I, for example, work in, which is a fertilizer company, we are producing fertilizers, we're shipping fertilizers, and then we're selling fertilizers. And our underlying assumptions is that our people will be available and our raw materials will be available to produce the fertilizers. Our logistical companies will be available to ship our products, and our end customers, which is traders and farmers, will have the demand for those products. And the message that I think we will try and kind of talk about in this session is that if we want to understand how strategic initiatives affect our business, we have to first look at all of the underlying assumptions within the normal business. And those assumptions are related to cost and availability of raw materials, cost and availability of shipping, cost and availability of workers, availability of liquidity and refinancing, demand for our product, and the volatility of the prices. So the underlying assumptions are kind of the same with or without the pandemic. It's important to look at the underlying assumptions of the business plan, whatever they are, and they would be the same in terms of the kind of the naming of the assumptions. They would be the same in any situation in the world. But then challenging each of those individual assumptions and seeing and kind of projecting, well, how can coronavirus affect availability of our stuff? And it can in many surprising ways.
Yeah. So let's grow on that. So the framework that I published back in 2017 is the Global Risks and Trends Framework. And it actually lays out that process that Alex has been talking about, that there is a list of assumptions that you have for your business, for the fertilizer business. Do you have workers? Do you have, availability? Are you going to be able to sell those products? And if you think of those along a continuum and how the macro events are actually changing those assumptions. So let's go to migration of workers. And we've seen not only with coronavirus, but we've been seeing, especially out of Northern Africa, a huge wave into Europe, and that was one of the triggers to the Brexit vote. So if you look at the underlying acceptance of migration of workers, that has changed significantly, even before COVID. But now, since COVID, there is actually a fear that may come with those workers. So we have seen in many industries that those workers are not available. Let's go on to sort of the other supply chain. I did volunteer work in Ethiopia early in my career, and so I've been watching the locust crisis in North Africa. Part of the reason for the spread so significantly was many of the chemicals to fight that battle come from Japan. And the supply chain was cut for several months to be able to get that pesticide into the market. So that the assumption, before this was that pesticide would be available. And we've seen that for many products, that now when you move that over to directly relating to the pandemic, we've seen that around PPE and also around pharmaceuticals. There's been a reliance upon some countries for those production. And, I'll give you a lot of Canadian-US examples just because that's where I'm from. We saw that with masks. 3M was supposed to ship Canada a whole lot of masks, and that was shut down. So the type of underlying assumptions that we had availability of supply chain now is questioned, not just within the, directly related industries, but also across many other industries. Then when you go to, the end of the supply chain for your product, is there going to be demand for the product that you are producing? Well, Alex said that, fortunately, demand still has been there. But for many others, we were talking about, what business have been most affected. Well, the very beginning of the pandemic, and everybody talks about the cruise line industry. And I liken the cruise line industry to Hotel California. You can check in, but you can never check out. It may come back, but you're not going to see their target market, which are seniors, flocking to cruises. Similarly, airlines and then all of the supporting tourism industries that have been significantly affected because the demand for their product has decreased.
Yeah, absolutely. I mean, I have a funny Canadian example on the effects of coronavirus. We hired an amazing executive from Canada. I mean, he's like one of the global leaders in the industry. and he's still unable to come to the workplace. So he's working remotely for the last few months. But yeah, I mean, cruise line industry is also quite amazing. I'm actually putting a bet on cruise line recovering. Not anytime soon, but when they do recover, I'll make a lot of money if they do recover.
Yeah,
So just for fun, I'm that kind of the risk manager who likes to take risks. I'm fully cognizant that they may not recover and I will not make money. But if they do, I'll make a lot of money, which is going to be fun.
Well, actually, that brings into an example of how we actually go to quantify these non-financial risks. And within the financial industry, there has been mainly a focus on credit and market. And within that credit and market, historically, there's been a focus on normal distributions and the acceptance of that. Now, we've had a long debate where we don't actually think that's the right way to do it, but historically that's what happened, and there's been more of a focus now to stress testing and scenario analysis and looking in the fat tail. But when you look at non-financial risks, you're really looking at extreme value theory and those 1 in 1,000 events, 1 in 10,000, 1 in a million events. So that historically, especially within the financial services industry, organizations have not been focused on those non-financial risks, partly because of that, well, it's 1 in a million. Like, this could never happen. The world that we are living in, the scenario that we are living in right now, if you modeled it, could never happen. People would not believe that we are living through what we are living through. And that's why I find risk management so exciting, because just because it hasn't happened before doesn't mean it's not going to happen. So, and when we look at those non-financial risks, they most often do not happen in isolation. So if again, I'm going to give you another North American example. If we look at what is happening in the West Coast with the forest fires, that is happening at the same time as we're having the pandemic. That is happening at the same time as we are having profound social instability in the US. And those, when you put them all together, give you a very different quantification of the impact than if those 1 in 10,000 events were to happen in isolation. And looking at interrelationships becomes very important. And Alex earlier talked about the fact that, well, maybe quantifying operational risk is just too difficult, so we just shouldn't do it. Well, I'm not saying that we shouldn't do it. And yes, it is difficult to identify and quantify those relationships. But if you look at the implications that just those 3 have had on, the U.S. economy, Oregon, California, and Seattle are currently in crisis. So I don't think that we can ignore those non-financial risks.
And let me try and kind of summarize, because for our listeners, and by the way, write questions underneath this video. We really want to structure kind of a theme and drive a point. So the first part of our kind of hypothesis of our point was that linking external big ticket global risks to strategy is important, because the impact could be deadly for the business. It's too big to ignore. And the way to link big ticket risk items to the strategy is through modeling or simulating the effect that those big ticket items may have on the underlying strategic assumptions. So the way to to quantify, the way to look at the risk impact is by looking at how underlying business assumptions may change. For example, one of the assumptions that is always challenged during the financial crisis is, will we be able to refinance our debt? And normally we would assume that yes, we would go to the banks and that would be willing to give us money. Maybe they'll ask for a bigger interest rate, but we would be able to refinance it. Well, that assumption often doesn't hold true when we live in crisis times. Banks just kind of close and do not give you're not able to refinance all the loans that you were planning to, and many companies default. And so the way to identify and quantify how strategic risks affect the strategy is by looking how the underlying assumptions change, whether they still hold true. And if they do hold true, for example, we will refinance, but the interest rate historically has been this much, and maybe this much. I'm trying to navigate the fingers. Will be double or triple the spread of what you had before the crisis. So trying to quantify strategic risks is very important, and the easiest way to do it is by looking at how volatile or how realistic the underlying strategic assumptions become. And that is why one of the important jobs for a risk professional is to very clearly understand what sort of assumptions are used when making business plans and when setting the strategy. And then, of course, we can attempt to quantify all those risks by running scenarios or simulations or stress tests. This is why those kind of three S's. I don't think they've ever been called 3 S's, but that's a good name that we should coin. Scenarios, simulations, and stress tests. Technically speaking, they're all the same thing, but it sounds really cool to say 3 S's. And that's one of the more practical ways on how we can challenge the assumptions. We can just simulate what will happen to our strategy or our business plans if those underlying assumptions will change.
Yeah. And when you do that, often what you will find is that you may have missed an underlying assumption when you went through it the first time, because you take that information from your 3 S's and then feed that back into your process. And a very important part of the GRAFT framework is effective challenge. So after you've done your scenario analysis and your stress testing, to really go back to your underlying assumptions and say, so I worked with one of the government agencies, and they were looking at higher education. And one of the assumptions that they didn't think was that important the first time around was looking at aging and the aging population. However, after they looked at their intake and where their numbers were going to be, what they realized is that because of the implications of cyber dependency and a shift in the underlying demand of the workforce, they were going to have a whole lot of individuals that were coming back for retraining, and what kind of programs and assistances they should be offering. So really important in your process to get that feedback loop into continuous learning about those underlying assumptions. One more point that I wanted to follow up on that you talked about was the implications for liquidity and credit. Having been in the industry for a long time, I think that I'm not going to be surprised, and then I am. So about 10 years ago, we started to see negative interest rates. And my assumption was 0 was the bottom. But I was wrong. And so what we have now seen through Corona is that we had most countries had an assumption that interest rates were going to be rising and that we were moving into a pretty good recovery. But now what we've seen is that with the large government expenditures, and my personal opinion is that governments will not allow interest rates to go up because they can't afford the interest payments. They just can't afford it to let it happen. So that our underlying assumptions about, macroeconomic theory of interest rates, have the real interest rates and also have a risk premium. Well, there is no risk premium built into our interest rates anymore. And if there is some kind of further shock to the system, that we are really living on the edge. And, back to Alex's sort of, getting into options on the cruise line, I really think that protecting yourself against an outside chance of interest rates going up, because if we move into some further crisis. Alex, back to you.
Yeah, I totally agree. And I mean, we have, as an industry, we have an underlying assumption that the price of fertilizers probably shouldn't go below the kind of the cost curve, the cost of production in some of the big supply regions, because surely in their right set of mind they wouldn't be producing at the loss, and so the price would kind of equalize. And so we've been modeling our investment projects and our strategic decisions on the assumption that there's a cost floor. And then, of course, that was immediately challenged by our board members as soon as the oil price went negative, because everybody just went like, okay, nobody really expected that. So many assumptions that we held true for years are becoming to be challenged, and it's very important to stress test them to just understand kind of how much fat the company can has to survive. Because if you're breaking covenants and if you have liquidity trouble, even with the mild shocks, then clearly the company is in trouble, and the risk manager needs to be very loud about the fact that even the basic stress kills the company balance sheet. But there was something else I wanted to talk about, something that you mentioned, because our overall message was that if strategic risks are significant, and if anything, there were a couple of studies by the Strategic Corporate Board and Deloitte called Value Killers many years ago, which basically I think their conclusion was that they've tested 2,000 companies that had a more than 20% drop in share price. And they tried to understand the underlying reasons or underlying risks of why companies lost value. And some went bankrupt, some took more than 7 years to recover. So basically, they've aggregated those collapses, and they're trying to understand. And their conclusion was, I can't remember the exact number, but I think it was somewhere around 60% was the strategic risks. So it's surprisingly, fraud, corruption was much smaller as the kind of underlying reason for true company collapse. Much more often, it's misunderstanding the market, changing in demand preferences, and dropping the decline in price and hence decline in revenue. So the overall message was strategic risks are super important. But then the second message that we're trying to give is that if you want to understand how strategic risks affect your business, then the easiest way to do it is by making the connection between the strategic risks and the underlying business assumptions, making the assumptions volatile, simulating what will happen if the assumptions change, and seeing how sustainable the business is. That's the very simple message that we're trying to give, and this is something that many of us at the Risk Awareness Week have been doing for years. We've been simulating strategic assumptions. However, the one important thing that I've recently again reconfirmed in my mind is that when you just simulating existing assumptions, you're still leaving a lot of the potential risks outside of the equation, because you're basically relying on the strategy department to incorporate all the reasonable assumptions into the model, which of course they do not. For example, they sometimes, as an example, sometimes if it's not a US dollar business, then someone may incorporate local expenses in the US dollar equivalent, and therefore once you put into the model, somebody made the decision, we're going to put in all the costs, even though the costs are in the local currency, we're going to put it into our strategic model as a dollar expense. And so as soon as they've done that, they've literally taken the chair from underneath you, because you're no longer able to simulate foreign exchange risk. Because no matter how much you add volatility to the foreign exchange, the underlying costs will not be affected, because there's no equation, local amount times the exchange rate. It's just the dollar amount. And maybe what I'm saying is a little bit too complicated for some of our audience. But what I'm trying to say is we cannot just rely on the assumptions that the strategic department put into the strategic model. Because the reality is they didn't put all of the important assumptions. And it's important to challenge the assumptions on one side, but then do your own kind of risk identification on the other side and match the two things. Because what you will realize is that some of the risks have never been accounted for in the strategic model ever, and therefore you cannot even you cannot simulate or stress test them until you change the strategic model. And we usually end up making significant changes to the strategic model to allow us to stress test all those risks.
So Alex, I'll give you an example exactly of that. So I worked with one of the, I would say, second tier financial institutions, Home Capital within Canada, with their CEO as well as their whole executive team. So what we actually did was go through actually this process. So we looked at their strategy, we looked at identifying what their assumptions were, then we looked at what were the I have to call them non-financial risks, because that's what we call them in financial services, and then did looking at trying to quantify the effect on the organization. And the interesting part about this was done in December of 2018, and they built their dashboard, and they actually identified the spread of non-viral diseases within their top 10. However, when they built their dashboard, they only built their dashboard on the top 5. However, very early in the pandemic, so even just when it was like December of 2019, they incorporated the spread of non-viral diseases within their dashboard. So they were ready to shift or pivot to the changes, and they were very quick to be able to go out, and they expanded their network capacity. So back in January, before sort of everybody else was standing in line, they got everybody set up with security software to work from home. So doing that preparation, you may not, we're probably not going to have another, well, I hope we're not going to have another, sort of COVID shut down the world event. But if you go through this process, then you can be prepared to make those decisions, even if you don't have it within your top 5?
And that's interesting. It's something that I talked with the chair of the audit committee last week. Kudos to the companies that had the vision to think about and simulate and stress test the effect of pandemics on the business, liquidity and revenue, expenses, personnel, and supply chain. Kudos to companies like that. They are in the minority, and but the important, and I think this is a very important message. The important message is that risk management, if it allows you to see the risks early on, and you still have the corporate courage to plan for that, that's amazing. But for all the other instances, risk management is about creating awareness and culture within the organization as kind of, something starts hitting the fan, that you react as quickly as possible. Because we went from kind of random conversations in the cooler room to full-on weekly calls with a dedicated working group, with monitoring and tracking across all risks that may be related to coronavirus within a day. Like we had one meeting where we said this looks more serious than we anticipated, and it was, I can't remember whether it was February or March. There was one meeting where we said it looks more serious than anticipated. We're already taking precautions on the human side, but we need to also start thinking about revenue and prices forecasts, our cash flow and liquidity and refinancing, and our supply chain. And we need a working group, and we need daily calls to discuss the status and track how we progress with different suppliers, customers, and the banks. And we went from this one conversation to the daily working group almost instantaneously. And then for the next couple of months, we had every single day a call with the CEO and all of the executive team discussing what are the major changes, how we stress test our product portfolio, how we stress test our liquidity, what are the issues that we're seeing, what are the responses that we're taking, what are the precautions that we're taking. So the important message about risk management that I want our participants to take away is that it's not always about foreseeing and predicting. I mean, if that happens, that's wonderful. It is more about being kind of on your toes when something starts happening, that you don't ignore it, or you ignore it for less time than your competitors, and you quickly get compact and start actioning and thinking about, and start thinking in different scenarios. Because we were running simulations weekly. We had worst case, kind of moderate worst case, possible upside. Which is something that I'm absolutely amazed about. We were, during all of this, we were talking a lot about different opportunities as well. Because as some markets started collapsing, a lot of opportunities opened up, and we were simulating, using game theory, how to kind of take advantage of certain business situations, which I thought was absolutely amazing. I mean, I thought that was that's what risk management is all about.
Yeah. So to bring that around. Risk management is not just about the downside, but at looking at opportunities. And we've looked at sort of a cross-section of industries, and we've talked about the ones that, have been hardest hit by the pandemic. But there is a whole section of the companies that have actually done very well. And if you look at the underlying assumptions that have driven them to profitability, it has really been COVID as an accelerant on trends that were already existing. So if you look at the rise of cyber dependency and the move towards working from home. So, the most prominent one in North America that we look at is the tech companies, and I don't know if I want to sort of give anybody a plug, but you know who they are, and how they have reacted. And if you're looking at the traditional industries, their market share has moved, at least temporarily, and in many cases, I would say permanently. I happen to live with 20-somethings, and the number of boxes that get delivered to our door is just a shift in the traditional purchasing. So looking not only at the underlying assumptions that could cause downside, but looking at the underlying assumptions that could grow your business and where are the opportunities. I worked through also early in my career the oil and gas sector. So I'm and also being in Canada, we're always watching the oil and gas sector. Also, to Alex's point, are people going to be continuing to produce when it's actually negative? I worked with Syncrude back when oil prices went from $40 to $10, and their price of production was $17. Well, when you have a huge fixed cost like oil tar sands, you don't just shut down. You must continue to produce. So they looked at what were the opportunities, what were the upsides, how were they going to get through this crisis in order to get to the other side, because they were not going to shut down. To that, what also happened was, and what we're seeing now is in crises, governments often step in and change the game. They came in, they privatized Dome Petroleum, and they waited it out, and then they brought it back to the market. So in looking at those assumptions, you've also got to be looking outside of the box to see what could be the potential game changers that change those underlying assumptions that that don't make sense, but they do happen.
And that's another very important message for everyone listening, is that our kind of overall theme is that if you want to get a good grasp on how strategic global things can affect your business, then the easiest way to look at it is through the volatility of existing assumptions, as well as maybe adding extra assumptions, because not always all of the assumptions have been kind of incorporated into the original business plan. But then the important point that Lois just mentioned is that assumptions don't discriminate upside from downside. Because when you look at the assumption, assumptions are the cost of logistics, availability of raw materials, or the volume of raw materials, the price of raw materials, foreign exchange, interest rate, the price for your product, the volume produced, the demand sold. Those are the assumptions, and if you get my drift, they all sling both ways. Like, for example, foreign exchange can go up or down, and that may have very positive or very negative effect. Volume production can go down or potentially up if there's more demand. Prices can go up or down. The supply chain, raw materials prices may go up or down. That's the beauty of looking at risk through the lens of assumptions, is that assumptions allow you to kind of instantaneously simulate both the upsides and the downsides, because we never kind of look at the business plan or a budget or an investment proposal and we say, let's model all the negative scenarios of foreign exchange volatility. Let's just model the scenarios where things get ultimately worse. We don't really say that. We just say, let's model the volatility of foreign exchange. Let's model the let's see what happens to our business if foreign exchange changes. We don't actually say whether it just changes positively or just changes negatively. We just say if it changes. And that implies that we incorporate both positive and negative scenarios. And that means that if you add volatility to each of those assumptions, then you run a Monte-Carlo simulation and you get your distribution as the result, your distribution would include both the upside and the downside. And you can make all sorts of important conclusions, whether the upside is bigger than the downside or the other way around, what's the probability of achieving your business plan, and so on. But that's the beauty of looking at assumptions and simulating assumptions, is that that can highlight a lot of potential opportunities. Because if you're seeing that certain things are going to be changing, and that has the potential to bring additional value to the company, then that kind of pushes you to the conclusion that let's make those decisions. It looks like there's good upside. Because I'm guessing a lot of the pharmaceutical companies and a lot of the tech companies, I mean, they were just kind of riding the wave of positive energy. I mean, the funniest story was how a random Chinese company that has a name that kind of was sounding similar to Zoom had 170% growth in their stock price just because dummies on the market confused it with the actual Zoom stock. I mean, the people were just kind of riding those positive waves, which I thought was very fun.
So one sort of wrapping up assumption that is changing that I want to talk to, just because it's near and dear to my heart, is the whole area of currency and what the assumption around currency is, and how I see that, we talk about fiat, but there's really a movement towards digital currency and the changing assumptions around that. And if you look at the continuum of, central bank coins, all the way through stable coins, all the way through non-regulated, Bitcoin on the extreme. And we are really in a seismic shift of the underlying assumptions that central banks will be the controllers of underlying currency. And as you look at, right now, 40% of global trade is in US dollars. There are digital assets that are being launched through the People's Bank of Central China. That's the wrong acronym. I apologize. That could potentially move the center of global finance. And these are the type of, when I was talking out of the box assumptions, that your business may have absolutely nothing to do with what you think is crypto. However, if the underlying shift moves away from global trade in US dollars to some other currency, that is going to have a huge impact on strategic assumptions and how markets work.
I mean, totally. Agriculture, the business industry that feeds the planet is US dollar based.
Yeah.
And if that were to change, I mean, that would have huge implications on everything we know about, food and the survival of human population. So those are absolutely fundamental things. But you are right, and I just want to kind of separate that message from the previous one, because let me just kind of constantly remind our listeners what we've talked about. Strategic risks are huge. We have to at least stress test our business models to see how those strategic risks will affect our business, because most of them will. and most of them will affect it significantly. The easiest way to do this is to stress test how volatility of underlying assumptions will affect our business. So the easiest way to check how strategic risks affect our business is by simulating volatility of underlying assumptions. The assumptions that the business currently has in their strategic model or in their business plan are not conclusive, so we have to separately identify additional risks and kind of compare that to the list of assumptions that we have in the business plan, because they're not going to match. And then the final point that you were making, which is kind of a separate, very important message, is that most of those kind of fundamental shifts are affecting our assumptions in such surprising ways. For example, even coronavirus. When it was kind of just first alarm bells in December, I had this conversation with the CEO, and he said, like, what do you think about Corona? And I said, well, it's going to affect our Chinese ports and our ability to get containers to transfer our goods to the Asian market, which wasn't, in terms of volume, wasn't that big. And my message was that it's going to be an issue, but it's not going to be a big issue. But he was obviously much smarter than me. He said, no, it sounds like it's going to be a much, much bigger issue. And back in the day, I obviously couldn't even imagine that it would affect our ability to refinance, it would affect our cash flow, it would affect our supply chain, it would affect our Latin American, North American ports, and our distribution there. I couldn't even imagine those things. And the very important message that you've just mentioned is that it's important to pay attention to those kind of left field weird developments, because we really, I don't think we as humans are capable of comprehending just how complex global business is, and how those completely supposedly unrelated things in cryptocurrency may change the way we do business, which is plain vanilla to us today. And this is a very important message. We really have to kind of pay attention to all those shifts and constantly remind ourselves, well, how could this affect my business plan assumptions, my underlying assumptions, and should I stress test it? And should I see whether that impact could be significant? Because if it's significant, then we should be having a conversation about it at the executive.
So if you look at, sort of, it has moved from what I sort of say outside of the ballpark to it's now in left field. Over 80% of central banks are now looking to issue their own stablecoin. The OCC in the U.S. has just allowed major banks within the U.S. to custody cryptocurrency, as well as the New York Stock Exchange has also provided a list of 10 approved cryptocurrencies for companies that are listed on the stock exchange to be able to custody. So those developments, as well as the testing of the central bank coin within China, within 4 major cities, it's just expanded to Beijing and is going to be moving to Hong Kong. There is also a regional coin that is being tested out between 4 Asian countries. So the acceleration of those non-financial risks are much faster than what they have been historically. If you think of, the acceptance of the telephone, the acceptance of the General Motor, those timelines gave us much more time to react. But now you've really got to be more aware, because they come at you so much more quickly, and because of the interconnectedness of our world, affect you in a much broader way than you may imagine.
I totally agree. And I think this is a wonderful kind of place to wrap up. And everyone, again, please ask questions, write comments underneath this video. But Lois, thank you. This has been amazing. I'm kind of excited to see where the crypto world will lead, because I mean, I until now I haven't really taken it seriously as, for example, as a personal investment opportunity. It has such a speculative historical implications that, but it has so much potential that surely it will lead to something amazing. So I'm really looking forward. I'm really looking forward to it.
Well, thank you so much for having me. I have to end on, I'm a very conservative person. And my view of crypto was that crypto is the emperor's new clothes. The emperor that is naked, and all the peasants can see that he is naked. But even I now think that there is something there. So I think if someone as conservative as myself now thinks it's going to be something, there's something there. So please, I have publications on the Global Risk Institute website around the Global Risks and Trends framework available, as well as I hope to have another benchmark best practices publication out soon.
And the links to all of that will be available just below this video, slightly to the right, so you can click on it and download the materials, and obviously visit the Global Risk Institute website for more information or to ask Lois questions.
Thank you.
Thank you, everyone, and we'll see you in other sessions during the Risk Awareness Week. Enjoy.